Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending December 16th, 2022. Appreciate you all tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, Fed Takes Rates Higher as China Reopens. And that's really the big story. China is attempting to reopen and the Fed taking up rates. That was expected. But what was unexpected was kind of the market reaction, and I'll get into that here in a minute. Let me pull that up as we go through this. But beginning of the week, we had the CPI data on Tuesday, about 6% on the core CPI year over year, so that was a deceleration. The overall consumer price index was another deceleration of 7.11%, definitely lower than expected. And then you just dig into all the data for the rest of the week. It was very on the side of, hey, the Fed needs to pause. You see that with the yield curve, with the 3-month and 2-year inverted, which is a clear sign that, hey, the bond market's sending. You're going to have to cut rates, and they're going to cut rates sometime later next year, is what the bond market is saying. And you can see that from the data. You have the CPI coming down, inflation certainly coming down, consumer price index month over month, that was only at 0.1%, so essentially flat. And then you have import prices down to 2.68%. We haven't seen this number since January of last year. Okay, export prices 6.35%. We haven't seen that number since February of last year. Okay, industrial production down for 2 months in a row. And what is this? 1, 2, 3, 4, 5 out of the last 7 months, it has been negative. So industrial production not doing well. Consumer spending, retail sales month over month down 0.58%. The consumer has 3 out of the last 5 months shrunk their overall spending. Then you have the business leaders survey in New York, current business activity negative for the 3rd month in a row and negative for 5 out of the last 6 months. The Fed's done its job. It needs to pause. Inflation's coming down. Most of all of this is shelter inflation that's priced into CPI and stuff, which is lagging. We're talking about services, it's down to 2-ish%. Physical goods, clearly negative for 2 quarters in a row, or 2 months in a row. So the Fed needs to pause. And right now they're at 4.25. The expectation is for a 25 basis point hike in February. But remember, we have the December data that's going to come in, and they don't meet until February 1st. Okay, so they're going to get the December data. They're going to get the data for retail sales during Christmas season, and it's going to be weak. Could they raise another 25 basis points? I think probably, but I think this is going to disappear. You're going to start to see the market price in either a 25 basis point hike or a pause, not 25 basis point and 50. Okay, and I think that's going to potentially give a lift to markets as this weak economic data comes in. March, expected base case is 25 and 25, 30% chance it's 25 and a pause. I think that's once again going to continue to shift downward. And that's what you should probably expect going forward. Let's dig into the charts here. You had the NYSE that rallied, found resistance at the 618 retrace. We pulled back to the 100-day moving average. We haven't broken anything. Nothing is broken to the downside. This is just a pullback from an overbought condition. Okay. And the question is, where do we go from here? We are clearly in the Santa Claus rally time period, the last 2 trading weeks of the year. Typically, you get light volume float higher. You also have China reopening. They're going to be lending more. There's going to be more credit creation there. And that does spread to the rest of the world. You had growth stocks kind of had a good day before the Fed, and then since the Fed, they sold off a bit. So kind of flat overall for the week. You had the VIX. It was another sign that, hey, this sell-off maybe doesn't have too many legs in the near term. You had the VIX pull back. and really have a flat week. So despite the pullback in markets, the VIX isn't really taking off. And even other volatility indices. This is the VIXN, which is the volatility index on the NASDAQ. That continues to be relatively low. Remember, lower volatility indices are positive for that underlying asset class. Here's gold volatility, that hitting lows we haven't seen since December of last year. So that's positive for gold overall. You have the 10-year. The 10-year pulled back a bit, but was kind of flat overall. So despite the hawkish Fed announcement, rates kind of pulled back, especially the longer dated ones. You look at SHY, that one also a bit flat. So it's not really telling you. You think SHY would be down big on this hawkish, that's what the headline was, how hawkish the Fed was. The bond market's not agreeing with it. Now, the positive for equities is that yield spreads didn't widen out. You had a bit of a sell-off the last few days, but you're not getting this true rollover, right? This is a pullback. It's been pulling back, but the equity market's been relatively good. Until this gets into a more protracted downturn, then I'll be a little more bearish on the market, but we're not quite seeing that yet. In addition, the dollar's getting a bit of a lift, but nothing too dramatic, right? Flat for the week. A stronger dollar is definitely bad for equity markets as a whole. Now, gold to GDX to GLD, that continues to pulled back a bit, but continues to be in an uptrend. Silver to gold, that one also pulled back, but continues to be in an uptrend. Let's look at gold to the SPY. Gold to the S&P, breaking out to the upside. So definitely more signals as well that, hey, the Fed isn't going to go very much farther than where they're at. Gold was held in there this week despite that supposed hawkish Fed announcement. Now, you did have a pullback in energy, but nothing broke. There's the XLE right to the 100-day moving average. And after the bell on Friday, you had the government saying, hey, we're going to start to refill our strategic oil reserve. And I think that was interesting. It could get a lift to energy markets here next week. Transportation index also pulled back, but hasn't broken any major support. ARC continues to grind lower, right near the 52-week lows. So certainly that part of the market is not very exciting. The IAI, the broker-dealers, pulled back, but you're still getting that relative strength compared to the banking index. And I think, if you look at them separately, you'll see it's more of a sense that the banking index is doing worse, those regional banks. And I think mainly that's because, the five largest banks right now, they have cheap deposits. They're not they have a lot of excess reserves, and people aren't moving them out or moving their deposits out in order to get higher yields yet. But they're starting to. But right now they can still charge basically nothing when it comes to their reserve or their deposits, and still charge higher rates on mortgages, etc. So that's really what's happening right now, and I think the regional banks are suffering because they are having to raise what they pay on deposits, and they're feeling the effects of an inverted yield curve, which typically restricts lending. So that's kind of what I think is happening on that front. So I don't know if I want to take too much of a signal from that outperformance of the broker-dealers index, but it is of note that this still remains in a relative uptrend. So overall, this is just a pullback within a broader uptrend that we've had since early October when sentiment was really bad. Now sentiment is not as bad anymore, but retail investors were betting big on the downside of the market. And so when there's a lot of protection already being purchased in the market, meaning puts on the market, it's hard for the market to really go down because not a lot of forced sellers. People are hedged. People are, people are fine with volatility. They're not rushing to the exits because they're protected. Usually, you get big sell-offs when people are unprotected and they're overly bullish, and we're not quite there yet. So, we're still in this holiday float season. I think there's a good chance we get one more decent rally into year end and into maybe the end of January. And then more trouble in the first half of next year, late first quarter, early second quarter is kind of the time frame that we're looking at. Could happen sooner, but with the China reopening, I think that's going to be a positive overall. And the Fed, I think the market's going to start to continue to price in a Fed pause, despite the rhetoric. And the Fed usually listens to the markets. So I think you could see some talk in the next month that, hey, maybe we should pause soon, or maybe we do one more and pause. I think that's the rhetoric you're going to hear coming up, because the economic data is going to continue to come in pretty light. But doesn't mean you have to sell off immediately. Right? The market in the near term, a lot is about positioning and the rhetoric around and the messaging around what the Fed is going to do and liquidity is going to do, et cetera. And I think there's more room for dovishness that could bring some positivity to the market. But right now, we get a little pullback into support, and at least near term, seems like a good buying opportunity. I think that's it. I hope you guys have a wonderful weekend. Get your Christmas shopping behind you. I know I need to do some of that today. And I thank you all for tuning in. And a reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a good weekend.